joining us on the third quarter 2025 Guide to the Markets web conference. I'm Grace, a client advisor from the Global Strategic Relationships APAC team, and I'm honored to be joined as always by Tai Hui, Chief Market Strategist for Asia Pacific. It should be an action-packed call today with no shortage of hot button topics to uncover and market developments to unpack, just even the past few weeks alone. So Tai, we're officially past the first half of the year and heading into summer. I know you just came back from vacation, which I'm sure everyone will agree is very well deserved, given everything that's been going on, not just in markets, but around the world more generally. And you and your team have really been hard at work in the past few months, pushing out updates to make sure our clients get access to all of our latest thinking. And some of these publications are featured here on the page. Do you want to give a quick plug on some of these?
Yeah, thanks, Grace, and good afternoon. Thanks for joining us. So I just got, I was back in the office last week, but I was away for a week in Chengdu. So for those of you who log on to our podcast, which you can see the QR code here, I did film the 100th episode intro on vacation. And then my team, they all provided their favorite episode just to recap what happened. And of course, for those of you who do use our Guide to the Markets, we have a daily guide where we update a lot of the charts that are relevant, that needs to be updated every day. And there, again, that's available on our website. So the QR code on the screen right now, one is to the podcast, the other is to the daily guide, and hopefully we can provide you with the important insights that can help you to explain the markets to your clients or to help you to make investment decisions.
Thanks, Tai. I think our clients always find these super helpful, so great to remind everyone of them. And it sounds like you didn't really get much of a break even on vacation. We're still working you hard then. So clearly we have a lot of ground to cover. And just to get things started, I thought we'd kick things off with a quick round of rapid fire questions, just to get through some of these top of mind questions that we're getting from clients. So ready?
Sure, let's go.
All right, so I think what's most top of mind right now ahead of Independence Day, the US managed to narrowly pass the One Big Beautiful Bill Act. So what does that mean for the US fiscal position? But most importantly, US Treasury, safe haven or sell?
So what we have on the screen right now is hopefully a familiar slide, but we did update it on the back of the OBBBA. And the top right-hand side, what you see is the fiscal deficits with the bill being passed. What you see over the next 10 years is around $3 trillion of additional deficits being added. And what you see here is that each year over the next 10 years, estimated by the CBO, is that the fiscal deficit will be around 6 to 7%. Now, bearing in mind that this is still in a growth environment, and yet we're still running a very large fiscal deficits, you can imagine what could happen if the US economy does fall into a slowdown or even into a recession where your fiscal deficit is likely to widen further. So I think overall, the fiscal picture from the US on its own, you can see on the bottom right-hand side, the accumulated deficits or debt is going to go from 98% of GDP in end of 2024 to around 124% of GDP by 2035 or 34. If some of these provisions were made permanent, it can go up to 130%. So the increase in debt over time is significant. But if you compare the US in 10 years' time to many of the developed economies like in Europe, that level of debt isn't that significant. It's similar, but it's high, it's similar, but it's not much worse than some of the other developed economies. I mean, for example, Japan's got a debt GDP ratio north of 200%. So I think from that perspective, market seems to, if you look at 10-year Treasury yields, in the last few weeks when the Congress was working through the bill, it ranged between 4.2% and 4.4%. So I think the market is aware of where the debt is likely to go over the short to medium term, but it's not being or the word about sustainability is not being reflected in the bond price right now, bond yield right now. So from that perspective, another thing to watch out for is, of course, the ownership of U.S. Government debt. On the left-hand side, you can see that foreign ownership has come down quite a bit from over 1/3 back in the 2010s to right now about 25%. So from that perspective, again, I think a lot of investors domestically, financial institutions, they'll continue to buy into US Treasuries. So the immediate threat to US fiscal position, I don't think is that significant. In fact, we are releasing in on the minds of investors later today, if not tomorrow, to discuss exactly that. And we will also discuss what does that mean for the equity market, who could be the potential winners and could be the potential losers. The sector selection becomes really important. But I think the passing of the bill is a big obstacle passed for the Trump administration. Another good news is the $5 trillion increase in debt ceiling means that the US, we won't be talking about debt ceiling for at least 2 or 3 years. So again, it helps to remove some of the tail risk. So overall, I do agree the US fiscal position deserves a lot of monitoring, but at least for now, the market seems to be relatively forgiving when it comes to the accumulation of debt by the US government.
Great. And just as we clear one hurdle with the OBBBA, attention now turns to the next looming deadline in the US, which is tariffs. So, Ty, deal or no deal?
Well, I mean, again, President Trump announced this morning that for a number of countries like Japan, the deadlines of 9th of July is going to get pushed to August 1st. But at the same time, he did announce for a number of these economies where I think there's no substantial progress in the negotiation. He said, look, by August 1st, here are the new level of tariffs, which are not that dissimilar to the reciprocal tariffs that he announced on the 2nd of April. So again, for now, I think the cliff of July 9th is okay for the time being, but clearly the can's been kicked further down the road. Now, what we have on the screen right now, this is a classic example of the difficult life we have in putting charts together. This is done as of the end of June, but if you look at the average tariff rates on US imports at the end of June, it's about 15%. So the absolute peak was on the 8th of April, including the 145% tariff against China. That clearly has been already negotiated down. But with the latest round of tariff threats, we could see that 14.9% back up to around 20 to 22%. We're still calculating the exact amount. So I think the challenge for the US economy is a couple of things. One is that the inflationary pressure from tariffs we have not yet seen, but I still think it's going to come. So some of the more recent inflation numbers, clearly the service sector is seeing some decline in inflation, but the goods side, I think, will contribute more in the second half of the year, something the Fed has to contend with. Number two, again, this type of negotiation back and forth is just not helpful from a corporate investment perspective. If you are a tech company, if you're investing in AI, that's okay. But if you're a consumer goods importer, importing from China, from Japan, from European Union, et cetera, you just don't know exactly what your tariff rate is going to be in 6 months' time. So I think that creates a lot of economic uncertainties that will by default create some downward pressure on growth. So again, we're not predicting recessions in the US, but this type of policy back and forth is for sure put a bit of a dampener on the US economy.
Thanks, Ty. And I think, you've touched on a few of these things: fiscal position, inflation, growth. So putting all of this together, what does that mean for the Fed outlook in the near term? Pause or cut?
I personally think the Fed's still going to pause. Well, July, absolutely. September, I still think it's going to pause. If I think back to my logic or the way I think about the Fed in the first half of the year, I'm thinking, well, Jay Powell and co. require some hard data to justify the cut. And, well, we are running out of runway for July anyway. We have one more job numbers and that's it. And then for July, for September, you have maybe 2 or 3 more. So unless the next couple of rounds of job numbers really, really poor and inflation comes down a lot more than expected, I don't think it gives the Fed a lot of justification for rate cuts. If you look at the futures market, it's pricing at about 2/3 or 68% of a chance of a 25 basis point cut in September. And by the end of 2025, 225 basis point cuts, so in total 50. So I think That's not unreasonable, but we need the job numbers to start turning soon for the Fed to really have the justification to cut rates. Now, we have also heard a number of Fed officials who may be aiming for Jay Powell's job start to talk about, oh, July could be a good time to cut because, the big boss man wants it. But again, I think this is a very dangerous game to play because ultimately a lot of the credibility of the Fed is from its independence, and therefore, basing their decisions on data to me is really important. And that's why I think, most of the officials may be still thinking, well, we've got room to wait. We don't have to rush into things. And therefore, I think personally, the first cut is still more likely to come in the fourth quarter of this year. You may get October and December, but again, a lot of that will depend on incoming data. And frankly, it means the current rate cut cycle is going to be relatively shallow going into 2026.
Great. So I think we have checked off all the hot button, US policy related questions, but bringing this back to portfolio implications as our clients and as investors consider equity markets, what are you thinking? Do we see a continuation of European exceptionalism or a resurgence in US exceptionalism as a theme?
Yeah, I think the European story is really interesting, right? Because in April, a lot of people were talking about people moving away from the US into the rest of the world. In some way, if you look at the flows data, that hasn't really happened. We've not seen wholesale departure from US stocks into other markets. But if you look at, for example, the chart on the left-hand side, and here's a new chart from our Guide to the Markets on page 57, we've mapped out S&P 500 growth and value for reference, just to see where the US market have been. And specific sectors in Europe, for example, aerospace and defense, banks, have done really well. Not just, since April, but actually going all the way back to 2024 or 2022. So what this tells you is that, especially with European governments planning more spending on defense, on national security, that is a clear catalyst for the industrial sector in Europe. But obviously, if you look at the right-hand chart, valuations in this particular sector has become relatively rich. So I think, the next catalyst will be for actual execution of those spending rather than I'm just going to plan to spend and everyone get excited. I think the next thing that could fuel further momentum in the defense sector will be for governments, especially Germany, to spend more. The execution becomes really important. We've had the planning phase, next execution. But if you look at, for example, European banks, despite really good performance in the past couple of years, valuation at this point in time still seems reasonable, right? If you look at right-hand chart, European banks, PE 10 times, in line with the long-term average. So from that angle, despite the strong performance in the sector, their earnings were able to catch up or at least match that expectation. So I think, I don't think there's one particular market that we think is going to be exceptional. What's going to be exceptional will be sectors in the US. We'll come back to that hopefully later. In Europe, banks seems very interesting. Defense may need a little bit of a pull, bit of a consolidation, but does it mean the consumer sector could actually start to perform a little better because of the additional spending by European governments and also rate cuts by the central bank? So I think all these put together, it does mean global diversification still makes sense, but within which the active management, the sector selection component is absolutely essential.
Sorry, so it sounds like it's active management exceptionalism then that we're looking for. And speaking of portfolio implications, the final burning question, given year-to-date US dollar weakness, what does that mean for Asian investor portfolios? To hedge or not to hedge currency?
No, it's a great question. I think a lot of Asian investors or APAC investors for the past 4 or 5 years, when the dollar is strong, they don't need to hedge their US equities or US fixed income exposure, right? Because the dollar gets stronger, convert it back to their home currency, they get gains both in the assets and the FX. You're right, the dollar's down about 11% from the peak. in mid-January. But if you look back to the past 10 years, you just plot the DXY or the US dollar index, this is the fourth episode in the past 10 years where the dollar is down more than 10%. Now, admittedly, this time round, the down leg is a lot sharper in less space of time. So if you annualize it, it's about 23, 24%. So it's compared to the last three episodes, in the last 10 years, the speed of dollar depreciation is pretty sharp. But at the same time, I think in the near term, let's say the third quarter, my best guess is that you would see some consolidation. Because again, if you think back to those episodes where the dollar index fell in the last 10 years, once they're down 10, 15%, they usually consolidate. Nothing falls forever. Just for example, the European Central Bank is now concerned the euro may be a bit too strong for its exports. So they may not cut rates on the back of that, but that type of concerns could act as a constraint on the currency strength. So flip side, the dollar could pause for consolidation. So in that sense, if I'm thinking about Q3, do I want to hedge? Maybe not, because the dollar may be looking to go more sideways and continue down. And I think on this page right now, on the left-hand chart of today's page 11 or 74 of the Guide to the Markets, again, this is a new page. On the left-hand side, we mapped out the hedging costs for a lot of the APAC currencies. So for example, if you are a Sing dollar investor, your hedging cost right now will be around 2.2 to 2.3%. So are you willing to pay that insurance premium to protect yourselves from further downside in the dollar? I think that's an important question. And also on hedging, you don't have to fully hedge your assets, right? You can partially hedge. For example, I've got $100 in US equities. I can hedge half of that or a third of that and gradually build if you think the dollar's got more downside. So I think as of right now, I think investors can just pause and wait a little bit. I think the dollar is going to consolidate. But in the longer run, the next 2 or 3 years, I'm not surprised if the dollar continues to depreciate. It's what President Trump wants, a weaker dollar helping US exports. And B, or two, a lot of international investors, they are genuinely asking the question of whether we should just rebalance their portfolio globally. So it's not sell everything in US. It's not that. But in the past few years, where many investors have been super overweight on the US, is it time to just revisit and rebalance the portfolio to have a little bit more in other developed economies, in APAC economies or APAC markets, in order to, again, pick from the very best companies in all parts of the world?
Thanks, Ty. So hopefully we knocked a few of those top of mind questions out of the park with the first 5 burning questions. But if I were to ask you for one word just to sum up everything that we've just got through and thinking about investing in the first half of this year, what would that word be?
So we put out our mid-year outlook a few weeks ago, right? And I use the acronym TUF, T-U-F. Tough, it is a pretty tough environment because of the policy. So what does that mean, TUF? Trade policies, unintended consequences from the Trump administration, and also fiscal policy. So the first and third, hopefully, are fairly intuitive. And I just quickly explain the unintended consequences. A lot of things that President Trump and his team is doing right now, obviously, their objectives. For example, anti-illegal immigration, their foreign policy, et cetera, et cetera. But a lot of the times, any policies can have unintended consequences. For example, the anti-immigration policies, what does that mean for the labor market in the US? If you want to grow, you have to put more people at work. But if you're deporting people or people are not willing to participate because they might get arrested, that creates pressure on the labor market, that create upward pressure on price and wages, that create downward pressure on growth. Foreign policy. We spoke about European governments and their new mentality when it comes to national defense. Again, US policies leading to a different mindset of US traditional allies, not just in Europe, for example, in Japan, in Korea, how would they think about defense and spending? Trade. We've discussed this many times in the past few years. How does all these tariff policies change the shape of global supply chains? And of course, the reaction from trade partners, from China limiting exports of rare earths and magnets to Europeans and the Japanese and Korean, how would they react? It creates a lot of uncertainties that we need to diversify our risks and allocation, and at the same time look for potential opportunities that could feed into this framework of unintended consequences.
Thanks, Ty. You outsmarted me. I asked for one word to sum up markets and you used an acronym to sneak in a few. Well, I asked ChatGPT the same question, and ChatGPT wasn't quite as tricky. So it gave me one word, which was resilience. And despite all the volatility and uncertainty, I think resilience makes a lot of sense because every major equity index is actually in positive territory year to date. And I think that's not really quite what investors would have expected or might have expected in the immediate aftermath of Liberation Day. So could you maybe unpack for us what are the dynamics driving this? Is this sustainable? What does it mean for investor portfolios as they plan ahead for the second half of this year?
Yeah, so again, in our monthly that just came out, I did ask the question: are investors getting numb on all this news? I don't think so. I think investors are still very smart and they are still investing in an informed and insightful way. But the truth is, with policies stop, start, flip flops, keeps changing, you honestly can't plan that far ahead, which means a lot of investment decisions will be based on the information we have in front of us because we just don't know what's going to happen 3 months, 6 months from now. The visibility is much poorer than where we were, maybe in 2024, 2023. So in that sense, if you look at the economic data, last quarter, we spoke about the soft data deteriorating, confidence numbers weakening, but hard data, production, job numbers, consumer spending, those were holding up. So the investors are looking at hard data and think, well, the economy is still holding up. Nothing's falling off a cliff yet. So I think that's partly drove the positive reaction in the markets. And also at the same time, Q1 earnings were not that bad. And then you've got, especially in tech sector, in AI, companies, the leading companies, they're still very much committed to invest. So I think all these put together, what you have here, if you look at this chart, sure, on the right-hand side, corporate earnings forecast been revised down, right? US, the green line. 6 months ago, market expecting 2025 earnings per share at 14% on growth. Right now, 8.7. Now, I did argue last quarter the 8.7 is still above the long-term average of earnings growth in the US, which is around 7, which I still think is a bit optimistic. But again, if investors have good visibility of what's going to happen in the second half, they're going to use the 8.7 and think, okay, what does that justify in terms of price to earnings? And as a result, S&P 500 or NASDAQ. So I think that's what's happened in terms of market sentiment. If you think about valuations, again, US is back to the more expensive end of the spectrum, something that we have highlighted in the end of last year. If you look at the rest of the world, Europe, in line with the long-term average. If you look at APAC, Japan, slightly above average. Of course, you've got markets like India, which is often a bit more expensive. But at the same time, China, we've seen some good valuation re-rating. Selected markets in Asia, like Korea, like Taiwan, like Singapore. So I think what we have right now is that investors are not ignoring the risks, but they are taking educated bets on what they know right now, which is momentum holding on. And of course, it could fall off a cliff, it could continue, it could even accelerate. But I think the core scenario that investors are thinking about is going to be more on just sustained earnings growth, a little bit softer, but nothing falling off a cliff. I think that's what has been sustaining the market rally since Liberation Day.
Yeah, thanks, Ty. I think we alluded to this earlier. Obviously, we explored and unpacked the European exceptionalism theme a little bit. US equities now have also come roaring back over the past month. And we talked about ultimately how it boils down to active management exceptionalism. So, when we unpack the US market a little bit, what should investors be focused on from a sector perspective?
Yeah, so we spoke a lot about concentration risk at the second half of last year, right? Your Max 7, your top 10 companies contributing to earnings and as a result, market performance. We did see some broadening out in the early part of 2025. But again, tariff really just put everything back in its box. So I think if we look at again the chart on the screen right now, on the left-hand side, two sectors stood out, communication services and tech, where the gray bar, which is the earnings consensus forecast for 2025, is actually holding up quite well. The gray dot is where things were 3 months ago. So in communication services, if anything, you've got some upgrades for 2025. For tech, pretty much holding on. Other sectors like industrials, such as materials, financials, there have been some downgrades. That's, I think, to do with a more cautious outlook for growth. But at least the starting point is that tech and communication services, that seems to be a good starting point for US equities. Now, of course, if you go back to the budget, the big, beautiful bill, there are sectors that seems to be getting some additional tailwinds. For example, additional spending, $350 billion on defense. Does that go into selected defense companies? Probably yes. There are lots of talks of deregulations on the financial sector, banks' capital base. There's a bit more room for them to lend, relaxing capital rules. Again, that could be helpful to the financials. On the other hand, healthcare, the potential cuts for Medicaid and Medicare, again, on the back of the bill, is that going to penalize hospital and healthcare services? Again, some of that I think has been reflected already in the price, but that differentiation by sector, by companies are going to be really important when we think about the US. One final point, profit margin. When we think about earnings, obviously revenue growth is key, profit margin going up or down, all of that impact on corporate earnings. The chart on the right-hand side on the screen right now is a new chart we looked at from 2016, just less than 10 years ago, the contribution by sector to S&P 500 margin growth. So over the past, 8, 9 years, margin for S&P 500 has grown by about 3 percentage points. And you can see the green bars, communication services, tech, financials, contributed around 2.5 percentage points. So, a big chunk of the margin improvement comes from 3 sectors. And the reality is, if you think about tariffs, it is going to press more on consumer staples, consumer discretionaries, because they import goods. Whereas tech, communication services, financials, they're more service-oriented. They should be a little bit more resilient, using your word from ChatGPT, Grace, when it comes to protecting their profit margin. So again, I think when you come to the US, I don't think we should throw the baby out with the bathwater. We should continue to invest in the US, but instead of thinking, I'm just going to put money in S&P 500 in an index fund, I think the active management is going to be absolutely essential. Of course, we can do options overlay. We can try to generate some income on the back of it. We can come back to that in a minute. But I think, just on the US market itself, the sector selection is going to be really important when it comes to finding or trying to generate alpha to build our portfolio returns.
Yeah, thanks, Ty. I think definitely selective among sectors is a recurring theme that I think investors should take away from the call. And as you can tell from my prolific use of ChatGPT, AI and tech is here to stay. I think it's increasingly integrated in our lives. Is tech just a US story, or how else can investors think about playing the AI theme in different parts of the equity universe?
Yeah, look, I think, first of all, the AI theme in the US continues. But again, I think just to remind everyone, not every AI model developer will come out on top. I was talking to a group of clients yesterday, and sort of show our age, of browsers. Someone shouted Netscape. Grace, you may not have heard of it. It's a very old version of internet browsers. If you think back to those days, many companies invested in those capabilities, but they ended up, one or two people or companies come on top. So if you think about AI developments in the US, not every developer is going to come on top. You can always go back to the hardware developers. I think that makes sense. But the level of potential overinvestment in the long term, that's something to think about. But if I come back to APAC, again, a new chart in the guide to the markets on the left-hand side. What we have here is the gray bars are the top 5 companies in hardware and IT equipment in APAC, their CapEx spend each year. Now, we can't name names, but I think you know who they are. They're mainly in Taiwan and South Korea that makes the hardware. You can see that over time, they have been building and building and building. 2022 was their peak year in CapEx because that's when demand for GPUs and processing power semiconductors really get ramped up. They're still investing, but they're pulling back a little bit, maybe because of the tariff uncertainties. But if you look at the green bar on the left-hand chart is top 5 companies in software and IT services. Again, I can't name names, but these are mainly Chinese tech giants. So what you have here is that, well, for the last 5-6 years, because of regulatory changes in China, these companies have been a bit more conservative in their CapEx. But you can see in 2024 onwards, they're again ramping up their spending in developing their AI technology, the applications that go with the AI technology. So in that sense, again, the hardware, the shuffle maker, they will continue to benefit from this development in China, in the rest of Asia. I think some of these companies that develop AI capabilities, again, not everyone's going to succeed, but those who are likely to succeed are those who can vertically integrate the applications, whether there's an e-commerce or financials or healthcare developments that can potentially benefit, their own market. So I think there's still a very rich potential from APAC perspective. I think we may see a bit more momentum in, at least for the short term, on the software side. You can see on the right-hand chart, both Taiwan and South Korea inventory cycle is going through a bit of a consolidation, but we expect that to rebound in late 2025, 2026. That will lead to stronger revenue growth. So there's still plenty to work with in APAC when it comes to technology.
Thanks, Ty. I'm flattered you think I don't know Netscape, but sadly it was one of my early introductions to the internet. But clearly it's evolved and broadened out a lot since then, and so good to hear how there's a global opportunity set when it comes to investing across the tech landscape. Now, I think just pivoting a little bit, I think it's easy for us to sit here today and say on hindsight that investors should have just stayed invested through the volatility in the past quarter and actually done well out of it. But we all know that during periods of heightened uncertainty, it can be very uncomfortable, and it's quite difficult for investors to stay the course. And I think in Asia, we've always seen from clients that having a stable, predictable income stream is really what helps them get invested and stay invested through the cycle. Now, fixed income is usually the place that investors would think to look for income. So how are we thinking about positioning in govies and credit right now to get that income generation?
Yeah, look, I think it's the growth of income, as I've been going on for a long time now, is really important in a world of high volatilities. Because look, if I buy a government bonds, of course there will be fluctuations in bond price, but at least I know what type of coupon or yields I'm getting. So that is never 100% certainty, but it's pretty certain. And that certainty in high volatilities is really quite valuable. So I think if I think about fixed income and just really broadening this out a little bit, I do think there's a case for what we call barbell strategy, where you have some govies, as you mentioned, and then on the other hand, some more high yield corporate debt, because ultimately we're not calling for a recession or a sharp recession in the US. Default rates naturally picks up a bit. It's very low right now. Spreads are very tight. But I do think the current level of yields do provide some offset in the short term if we do get a deterioration in economic growth. And don't forget, in the high yield market, a point that we've been highlighting for some time, a lot of the issuers' quality has improved over the past 5, 10 years because some of the lower quality names have gone to the private market, private credit, for example. So from that angle, there's a structural shifts in the high yield corporate bond markets. So the barbell with corporate bonds, high yield on one side, and then government bonds on the other side. Now, I think for most of the first half of the year, we've been telling investors and clients maybe we should focus on the shorter end because a lot of these fiscal uncertainties, policy uncertainties that could swing the long end 10 years, 30 years a lot more. But with the passing of the big beautiful bill, I suspect, as I mentioned earlier, investors are now much more aware of the change or the rise in fiscal debt over the medium term. And if the current valuation seems to be okay with it, at least for the short term, they may not be that concerned. Of course, there are other risks. Tariff, could that raise inflation? Could that delay the Fed's rate hike? That's a risk we have to contemplate with. But I think, the volatility in the longer end, maybe one of the key big problems is, at least for the short term, out of the way. So I think there's an argument to lengthen your duration to some extent to improve your carry, to improve your pickup. Of course, there will still be volatilities, but again, as I said, a big rock or big uncertainty has been taken out of the way. So if you look at the global bonds, again, not just focusing on the US, there's a strong argument for investors to look at Europe, for look at other developed economies, because their central banks could still be on a rate cut path. And frankly, their governments arguably at this point has a little more credibility and or fiscal discipline, and that is what investors are happy about. So, we saw, for example, the UK went through a bit of a volatility the last couple of weeks, again, because of questions over Labour parties or Labour governments' ability to maintain fiscal discipline. That was quickly addressed. I do argue there's a much more competent government than what happened, back in 2022. But nonetheless, I think, globally diversified, just like in equities, in government bonds, makes sense. I think in the case of the US, right now, I feel a bit more comfortable just lengthening that duration because the budget uncertainty is not out of the way, but certainly much better understood by the markets.
Great. And, I think while bonds continue to provide that much needed income and some level of diversification to a global equity portfolio, we've seen that during periods of market stress, this hasn't always worked as intended. And so, investors might also wish to hedge against other types of uncertainties, high equity market valuations, inflation. So what other sources of income can investors tap on to diversify?
Yeah. There are the big four, right? Fixed income, we just talked about, equity dividends. We didn't really talk about this much this time, but that's very much a bread and butter for a lot of APAC investors, especially, for example, in China, where cash rates are very low. The other two, one is alternatives. And this is something that, again, we've been sharing with all our APAC clients for quite some time. On the screen right now, you see the blue bars. These are the asset class yields for equities will be orange, fixed income is gray, and alternatives are blue. So things like transportation, infrastructure, real estates, these are typical alternative assets that can generate income. And the good thing about these is a couple of things. One is, for example, infrastructure or transportation. Often the contract is inflation linked, so it does provide a bit of an inflation hedge. And also, if you own a ship, for example, and if you are renting it out or leasing it out, it's usually for multi-years. You don't lease it for like a month or a week. It's usually a number of years. And what that means is you've got a much more predictable, much more consistent income stream. Again, more foreseeable. So you kind of know what you're going to get, the cash inflow over the medium term. So, I think from that perspective, that creates a lot of opportunities. And of course, with a more complicated, more diverse supply chains, you are going to get more demand for shipping. Instead of just going from Shanghai or from China to the west coast of the US, now a particular product we have to stop over in several locations before it gets shipped to the final customer. So I think overall there's structural demand for transportation, and as a result, infrastructure that goes with it. And of course, in various markets, real estate is another option. On the chart on the left-hand side on the page right now, you see the size of the circle. It's the level of yields. And again, if you look at infrastructure and private market real estates, these are pretty decent sized circle or bubbles. I don't want to use with the word bubble here. It's a very sensitive word, but circles, indicating the level of yields for various alternatives. So I think there's a lot of things you can explore. That's number one. Number two is increasingly we're seeing options overlay being applied to equity strategies where you do give up. Look, there's no free lunch. You do give up some upside potentially on the equity markets, but in exchange, you do get a consistent income stream via options premium. So, if you agree with me, for example, that the US market will be okay, but the upside is going to be somewhat limited because certain sectors are going to perform not so well. Tech doing okay, that's fine. That will give some lift to the index, but other sectors may be a bit of a drag. Then selling options premium, I think, potentially could be a very good way to generate that income while also managing the volatility of your equity portfolio, whether it is a US or global equity allocation, or even an Asia or APAC equity allocation. So I think that's a increasingly popular way for investors in the US, in Asia, around the world to generate income while managing the equity allocation volatility.
Thanks, Tai. I think we can all agree that in today's uncertain world, the certainty of income, especially from some of these alternative sources like real assets and call overriding, is certainly very appreciated. Tai, we've covered a lot of ground, so I think would it be helpful for you to perhaps paint a quick summary of some of the top conviction ideas and outlook for the year ahead?
So macro-wise, TUF, tariffs, fiscal policy, and the intended consequences from the Trump's administration is going to keep volatilities elevated. So, there will be a lot of uncomfortable moments in the second half, and we will be with you along the way. So, we will set up calls, and of course, you can ask questions via your JP Morgan Asset Management client advisors. They'll come to us, and hopefully we can answer your questions. And softer global growth as we approach the end of 2025. Ultimately, the Fed is still holding on to relatively high level of interest rates for good reasons, but it also means that US growth, alongside with policy uncertainties, is likely to see softer growth, not recessions or sharp recessions, but softer growth. The Fed cut rates gradually. I think many officials are trying to protect its independence, and therefore they need hard data to justify their moves. But at the same time, other central banks are also allowed to ease with low inflations in their markets. Equity-wise, globally diversified. Don't throw the baby out of the bathwater. Don't throw your US equity allocation to zero. But I think there's definitely the case to explore a little bit more on APAC, on European equities. But no matter which market you're in, it's going to be about active management, trying to find the sectors that feed into policy changes. The policy can be a tailwind, it can be a headwind. You avoid those sectors where policy is a headwind, and then get into the sectors where policies are a tailwind. Fixed income, barbell, high yield, corporate debt, and long of government bonds. Government bonds protect you from me getting wrong. If I'm wrong and the economy goes into a recession, government bonds, falling yields, higher prices gives you that protection. But if I'm correct and the economy continues to grow, albeit the gradual pace, then the high yield developed market corporate debt provides that income component. And frankly, a 7-year or 10-year US government bonds at 4.3, it's not so shabby. It's actually higher than a lot of the inflation rates that we see in APAC right now. Income generation, I mentioned 4 things, the big 4: fixed income, equity dividends, but also consider alternative assets and option overlay equity strategy. So I think these are the key takeaways I would like to bring you this quarter.
Thanks, Ty. Just wanted to kind of close out the call. I come across this, really interesting quote from the great Charlie Munger, where he kind of mentioned, I want to swim as well as I can against the tide. I'm not trying to predict the tides. And I think a lot of the advice you shared with us today really is about facing the choppy waters of today's markets head on, through diversification, through active management. Any closing thoughts, words of advice you want to leave our audience?
No, I think it's a great quote because a lot of things that we as investors face, we can't control. You talk about swimming against the tides. Sometimes I also think from a sailing analogy where, the wind may not blow the way you want to go. So you just got to move the sail in a way that is zigzag. It's a bit slower, but, you can still get to where you are by keep on adjusting your sail. So I think from that angle, the allocation that we spoke about or discussed today is one way to address the potential headwinds that's going to come. And frankly, over the last 12, 18 months, when we prep everyone for the US elections, we spoke about, okay, what are the sectors that could potentially benefit if we get into a tariff war or deregulation or regulation. And some of these have worked out quite well. So I think the key here is, there is no home run or slam dunk in investment this year because the policy environment is so challenging, so choppy. But I think, we can slowly accumulate, a one win at a time rather than trying to win the league in one go. And then again, it comes back to the role of income. Income may not seem that exciting. It's not the home run, that 30, 40% that you want to get from stocks or investment, but just going steadily and gradually 4-5% clipping, that in a tough environment is not a bad result.
Great. So back to basics in a tough environment. So I think we're very close to the end of the hour. I just want to remind everyone again, there's a great wealth of information that Ty and team are putting out on a daily basis almost at this point. So, please do access some of those great resources that Ty shouted out at the start of the call. And again, thank you so much, Ty and team, for all the great content you're putting out. As you've heard from him, a lot of new slides in the guide, some upcoming articles that the team will be publishing on some of the questions that you've put through. So please stay tuned for that. And thanks again for the great support and tuning into the webcast.
Thank you, Grace. Thank you, everyone.
Thanks, everyone.
Thank you.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.